In Chapter 11, we are going to look at auditing the purchasing process. I know I didn't get a chance to do a voice for Chapter 10's revenue process, but hopefully you were able to read through it and get a good understanding of it. So now we're going to look at the other side, the purchasing process. So we need to understand what's involved in this process. Expenses and liabilities are your major items. And I'm going to refer you to page 451 of your book. And I got to find my glasses too. All right. So what we're talking about here is auditing for a lot of companies, their inventory system, how they purchase their inventory, how they pay bills, and all of those items in that process. So we need to really understand, oops, wrong chapter. I'm in chapter 13. You guys don't want to be there yet. Now I'm back into chapter 11. Okay, so we're focusing on, once again, the purchasing and payment of goods and services. Okay, so what kind of accounts are involved and what kind of recognition issues? What are the rules regarding them? Well, the two major accounts are expenses, which are outflows or the other using up of assets, or incurrences of liabilities. We know that from our intermediate accounting class. Liabilities are the probable future sacrifices of economic benefits arising from present obligations. So they're things we're going to have to pay for, right? So I like to look at expenses as basically we're receiving a service or we're using up an asset in order to provide our own product or service. And liabilities are those items we have to pay for related to that. So our expense categories generally fall into one of three categories based on the type of expense it is. It could be a product cost. So those expenses that could be matched directly with revenue, like cost of goods sold. Another one is just a period cost. It's just an expense that happens during that accounting period. Okay, it can't be directly matched with an expense, but just because of the passage of time. And most of our expenses fall into this category. And then there's this systematic allocation, such as depreciation. So we're not looking to see actual decrease in value in an asset and measuring it that way. We're saying, here's the cost of an asset. We're going to follow a systematic allocation of expensing it. We use a formula. Okay, so expenses generally fall into one of those three categories, and we need to know that before even going in and doing any audits related to them. The next thing we need to understand is how a company purchases. What is their purchase process? And if you stop and think about this, and what I like to tell students to do too, so you really get a hold of it, is kind of make your own little forms here. The first one would be your purchase requisition form, and have 2 or 3 copies of that, because you're going to be in the organization. People each get copies of these. Purchase orders, same thing, and receiving reports. So a purchase transaction usually begins with somebody needing something, and it's usually a manager or supervisor who generates a purchase requisition. We would like to buy something, and they fill out a purchase requisition form. Then the purchasing department itself, which is usually another department within the company, receives that purchase requisition and prepares a purchase order requesting, and they may even negotiate with the vendor over the phone on price, quantity, delivery, etc. But the details of the actual purchase are put on the purchase order. When the goods are received, a liability is recorded, and usually a receiving report is created so that the company knows the goods are there. At some point, and we'll get into this in a few minutes, The accounting department will collect a purchase requisition, a purchase order, and a receiving report in order to match all of those specific documents to an invoice from the vendor, the bill, in order to create an accurate and complete liability. So that's a general overview of how purchasing usually occurs. The three types of transactions that are processed through the purchasing are the purchase transactions. Okay, so all the items that we purchase. And what accounts will be affected? Well, it depends on what you're buying or paying for or recording as a liability. Accounts payable will be. Inventory. The purchaser cost of goods sold account. And various assets that you may be buying and expenses that may be recorded as liabilities through the purchase area. The other type of transaction are cash disbursements because you're going to pay for the accounts payable. So cash could be affected. Accounts payable. Cash discounts if you pay early on a bill. Assets could be affected and expense accounts if you pay those directly. You pay for rent with cash. Hello. It may not rent through that purchase transaction area. Purchase return transactions. Okay, so this is when the company is sending back inventory. They're returning it. Or they receive an allowance on the inventory. They get to pay a lower price because it might have been damaged when they received it or it was the wrong color. And they worked out a deal with the vendor. Accounts payable. Decrease your bill if you return something. And various other asset and expense accounts may be affected. So we need to be familiar with the accounts involved in this process. And that gives us a nice overview. So here is a flow chart, and this is what we do in auditing so that we understand the purchasing process of the company we're working on. And this is also illustrated on pages 390 to 391 of your book. Excuse me one second. Okay. So again, we start with the purchase requisition. The manager approves it. An approved purchase requisition is received in the purchasing department. Okay, and they're going to input information into the purchase order program. Okay, and then information is going into the purchase order file and accounts payable master file. Okay, the purchase order is then created into 4 parts. One is sent to the vendor, one goes to accounts payable, one stays in purchasing, and another one without detailed information, amounts ordered or dollar amounts, goes to the receiving department. Receiving takes the purchase order, and when they get the goods, they count them and inspect them, and they report the amount on the receiving report. They enter the vendor, quantity, and purchase order. That receiving report is then compared. You compare the invoice to the purchase order and the wet requisition, and the receiving report. It's then contained with the invoice into a voucher packet. Okay, and then accounts payable is updated. Okay, the open purchase order report may be printed to show which purchase orders have not been received yet. There could be an expense distribution report that is printed, a voucher register, how many vouchers are out there that are ready to be paid, aren't paid yet, and a cash disbursements journal. So this is showing you how this information is flowing through to different reports and ultimately to the general ledger file, into the general ledger account. So we do this, especially on our first run through on an audit. We really need to understand what is happening with the purchasing process. And this is the example given for earthware clothiers. Okay, the rest of this process is showing us how ultimately the items are paid for. So once the voucher packet is looked at, it's authorized to be paid. It is then paid, and authorized signers will send out, will ultimately sign the checks and send them out. The cashier in this case. And these are the different departments, as you saw across the top, responsible for the different activities. And we want to make sure we know that, especially when we're determining separation of duties. So again, the types of documents we'll be seeing during this process: purchase requisitions. That's our request to purchase. Purchase orders, though, include the description, quality, and quantity of goods being purchased. Receiving report reports the amount we received. The vendor invoice then is the bill containing what you received, how many, what was charged, and the total amount. The voucher is the basis for recording the vendor's invoice. So the voucher is basically what we call the package of the purchase order, receiving report, and vendor's invoice, all checked and shown to be authentic. The voucher register, which is also a purchases journal, is used to record the vouchers for goods and services. So that's when we're entering the invoice into the system. Accounts payable subsidiary ledger is the detailed amounts of accounts payable and who is owed those amounts. So it will list each individual vendor the company owes money to and the dollar amount. The vendor statement is the statement received from the vendor representing what type of purchase activity and payments were made by the company. And then the cash disbursements journal or check register will show the amount of cash and the various accounts affected by those cash payments. So there it is one more time, our major functions. Requisition is the initiation and approval of request. Purchasing is the approval of purchase orders and proper execution as to price, quantity, quality. Receiving properly receives authorized goods. Invoice processing is when the vendor invoices are processed and adjusted and matched up to purchase orders and receiving reports. Disbursements are the processing of the payments to the vendors. Accounts payable is the recording of all vendor invoices, cash disbursements, and adjustments in individual. And finally, the general ledger accumulates that information into control accounts. Now, as an auditor, after understanding the major areas of the purchasing process, we also now have to understand key segregation areas. So we want to make sure certain areas are especially segregated. So the next few slides will talk about what we want segregated, and if it's not, possible errors or fraud that could result. The first thing is the purchasing functions should be segregated from the requisitioning and receiving functions. So all three of those should be separated. If one individual is responsible for asking, buying, and receiving, man, you're opening yourself up to some fictitious purchases. The invoice processing function should be segregated from the accounts payable. So if one individual is responsible for invoice processing, so matching them all up, the information all up, and then putting it into accounts payable, purchase transactions can be processed at the wrong price or terms, or disbursement can be processed for goods not received. So errors could just occur. The disbursement function should be separate from accounts payable. So if one person is responsible for making the checks, for dispersing the money, and has access into accounts payable records, they can create unauthorized checks for fictitious documents, fictitious accounts, and that could lead to theft. The accounts payable function should be segregated from the general ledger function. So if one person is responsible for the general ledger and the subsidiary accounts payable records, they can conceal something that would have been detected by reconciling the records from the accounts payable subsidiary ledger to the general ledger control account. So, preparation and approval of purchase orders should be done by the purchasing department. Receipt should be done by receiving. The vendor invoices should be matched by accounts payable, and they should code them and update accounts payable. So should IT be involved? The preparation of vendor checks should be done by IT. Signing and mailing of the checks, cashier. Preparation of your voucher register, your report, IT, your purchasing report. And reconciliation of voucher register to the general ledger to make sure everything's reported properly should be done by accounts payable. So you can see how it's all separated out so that one area is not responsible for too much of the duties. Okay, so we understand the separation of duties. Now we have to start assessing inherent risk in the business. And some of the things that we look at would be industry-related factors. So there's two important industry-related factors. The first is the supply of raw materials adequate? So do they have enough? That's an inherent risk, and that's something the industry should be and the company should be addressing. And how volatile are raw material prices? Okay, are they relying too much on one vendor? How are they preparing themselves for it? Another inherent risk is misstatements detected in prior audits. So generally, the purchasing process is not difficult to audit and does not present contentious accounting issues. It's usually not a high-risk area. However, if there's past audits that had issues, you must assess your inherent risk accordingly. So take those prior audit experiences into account when determining the inherent risk and how it's being addressed. Next, we need to assess control risk. Okay, so we need to understand our 5 parts of internal control to really be able to assess the risk we have with internal control. We need to understand and document the purchasing process based on a reliance strategy. We must plan and perform tests of controls on purchase transactions and set and document the control risk for the purchasing process. So what we need to make sure of is, first, and it's not on here, but I want you to go to page 396. What's the control environment like? So the structure of the company itself will impact how an auditor feels about control risk. What kind of authority and responsibilities for purchasing are there? Is there limits on how much somebody could authorize for? These kind of factors go into your understanding of the control environment. The second is the entity's risk assessment process. Okay. How does management look at the risk involved in the purchase process? And then there's information systems and communications, and that's what our slide picks up with. For each major class of transactions in the purchasing process, the auditor should obtain the following: how purchase, cash disbursements, and purchase returns are initiated. Who starts the process? What accounting records, supporting documents, and accounts involved in processing purchases, cash disbursements, and purchase returns. So we want to know all the different accounting documents we may need to look at. The flow of each type of transaction, like we saw in that flow chart, from initiation into the financial statements, including any computer processing of data, and the process used to estimate accrual liabilities, because that's part of our process as well. A lot of times they'll be able to determine this information by a walkthrough. Okay. We also want to be concerned with how the company monitors their controls. Do they have stuff written down? Are they looking to make sure the controls are working? So after we go through this internal control area and we collect some information, now we could assess our control risk. So after testing controls, the auditor sets the achieved level of control risk. When tests of controls support the planned level of control risk, no modifications are necessary to planned detection risk. So you don't have to change it. What you have planned is adequate. The auditor may proceed with the substantive procedures as planned. When tests do not support that, the auditor lowers the level of planned detection risk, which will lead to more substantive procedures. So now you could see why we talked about all of those risks before we even started auditing, because those assessments really impact the level of auditing we have to do in order to feel comfortable with an account being fairly stated. Remember, we always have to document our control risk as well. Now, control activities and how we test controls. So first we have to look at the assertions about the classes of transactions and events for the period under audit. So we want to look at the occurrence. Are all purchase and cash disbursements recorded and have occurred and pertain to the entity? Completeness. All purchase and cash disbursements that should have been recorded have been. So did they occur? Are they all there? Are they all properly authorized? Are they accurate? Have they been recorded appropriately and properly totaled in the journals and ledgers? The cutoff. Are there any transactions, have they been properly cut off? Is anything in the incorrect accounting period? Is everything in the correct accounting period, basically? And then classification, your purchase and cash disbursements have been recorded in the proper account. So those are our assertions we want to, and we're trying to prove here. So how do we test these controls? Well, in occurrence, we could observe and evaluate proper segregation of duties. You may test a sample of vouchers for the presence of an authorized purchase order and receiving report. Examine paid vouchers and supporting documents for indication of cancellation. So what we're proving here is, did it even occur? Is there stuff in there that shouldn't have been because it didn't occur? So these are the types of tests that can be completed. Completeness. Review procedures for accounting for numerical sequence of purchase orders, receiving reports, and vouchers. Are they using numerical sequences? Trace a sample of these receiving reports from the receiving reports to the vendor invoices and vouchers. Make sure the numbers are all in jive. Authorization. Sorry, I need a drink of water. Okay. Examine your purchase requisitions or purchase orders for signatures, and review any kind of competitive bidding process that may need to be present, especially in government audits. Accuracy. Recompute the mathematical accuracy of a vendor invoice. Even if it's computer generated, you want to make sure everything's added up correctly. Agree information in the sample of vouchers for product, quantity, and price. Examine reconciliations of vouchers to your daily accounts payable report. Make sure that they're all accurate. Cutoff. Compare the dates on receiving reports with the dates on the relevant vouchers. So receiving reports are really our definition of who owns the goods. When did we receive the product? Okay, so just because something is ordered doesn't mean it's inventory. Okay. What's important is, do we own the goods? Compare the dates of vouchers with the dates they were recorded in the purchase journal. And then classifications. We're examining a sample of vouchers to make sure information is properly classified. So some tests of controls. Now, what about the occurrence of cash disbursements? Okay, so we looked at the typical tests of controls for purchase transactions. What about this other process, cash disbursements transactions? So the auditor is concerned with misstatement caused by a cash disbursement being recorded in the entity's record when no payment was made. The primary control activities to prevent such misstatements include segregation of duty, reconciliations, and review of vendor statements. So we check vendor statements, see if we agree with one another, and bank reconciliations. Very important to complete that process as well. The major audit concern is that a cash disbursement is made but not recorded. So the other side of it. In addition to the example control test discussed for occurrence, the auditor should also account for the numerical sequence of checks. Are all the checks that were written, are they all recorded? Authorization. Are they all properly authorized? Is there a proper segregation of duties? The individual who approves a purchase should not have direct access to the cash disbursements. Those must be separated. One of the major audit concerns is that the payment amount is also recorded incorrectly. So we want to make sure accuracy is happening. To detect such an error, entity personnel should reconcile the total of the checks and electronic funds transfers issued each day with the daily cash disbursements report, because that's what's being used to update our cash T account in our general ledger. The cutoff of cash disbursement transactions. The auditor's test of controls include reviewing the reconciliation of cash disbursements with postings to the cash disbursements journal and accounts payable subsidiary records. The auditor also tests cash disbursements before and after year-end to ensure that transactions are recorded in the proper period. So we don't want something to be recorded in the incorrect accounting year. The auditor is concerned that a cash disbursement may be charged to the wrong general ledger account. So we want to prove the assertion of classification. So we have all of those assertions: occurrence, completeness, authorization, accuracy, cutoff, and classification. So we use a chart of accounts as well as independent approval and review of the account code on the voucher to provide adequate control. Finally, we looked at purchase process, cash disbursements process, and then there's the purchase returns transactions. So usually these are not a lot. The number and magnitude of purchase return transactions are not material. It's what we returned of the inventory we bought at the company. So the auditor normally does not test controls. They'll use substantive analytical procedures to test the reasonableness of the amount because it's not even material. Once the test of controls are done, now we have to determine our substantive procedure. So if the results of the test of controls support what we thought the control risk would be, the auditor conducts the substantive procedures at what we planned. If the results do not support the planned level of control risk, so there's more control risk than we originally thought, the auditor is going to reduce the detection risk. We don't want a lot of detection risk. This will cause more substantive procedures to be included in the audit. So the next part of this really comes out of what did you find during your control tests and those assertions. Okay. So when we're auditing accounts payable and accrued expenses, so now we're going into our substantive tests. There's some assertions about account balances. So the controls test the controls with how the stuff got in there. How's that, what are the procedures around getting the information into the account? The substantive test now is focusing on the account balance. How can we test? What do we have to worry about with that account balance? What are our assertions? First of all, it exists. So accounts payable and accrued expenses are valid. The rights and obligations. Accounts payable and accrued are obligations. We actually do owe them. Are they all there? And are they valued and allocated correctly? Okay, so these are the assertions that are trying to be proved during this part of the process. So how do we do that? Well, occurrence and rights and obligations, we want to make sure with disclosures, presentation and disclosure, that all disclosed events, transactions, and matters relating to accounts payable have occurred and pertain to the entity. Especially, you want to make sure that, just number one, you want to make sure they're all there so that the proper amount of liability, but occurrence and completeness, I always put together, but occurrence means it's authentic. What's in there actually is what we owe. Completeness is everything's there that we do owe. Classification and understandability is financial information relating to these accounts payable and accrued expenses is presented and described, and any disclosures that are required are clearly expressed. And also, one more time, financial and other information relating to accounts and payable and accrued expenses are disclosed fairly and in appropriate amounts. So we're focusing on the disclosure side, the notes. Is everything in there? If everything that's in there, do we actually owe it? Is it classified properly? And are we disclosing the information properly? When I say that, I mean, is the company doing that on their financial statements? So, first we could perform some substantive analytical procedures, and you've done this with your IDEA software and through your Earthware cases. So, some substantive analytical procedures on accounts payable and accrued expenses are: compare payables turnover and days outstanding in accounts payable to the previous years in the industry. Compare current year balances in accounts payable and accruals with prior year. Compare amounts owed to individual vendors in the current year to prior years. And compare purchase returns and allowances as a percentage of revenue or cost of sales to prior years. So we're just trying to see if there's any weird stuff happening just based on our analytical procedures, to see if anything is worth investigating more based on industry or past history. Test of details of transactions, account balances, and disclosures continued. So how do we test for completeness? The auditor should conduct a search for unrecorded liabilities. That includes the following: ask management about control activities used to identify unrecorded liabilities and accruals at the end of an accounting period. These controls should be part of the closing process. Vouch large dollar items from your purchase journal and cash disbursements journal for a limited time after year end. Maybe some of them should have been in the year we're auditing. Examine the date on each receiving report of vendor invoice to determine if the liability relates to the current audit period or not. examine the files of unmatched purchase orders, receiving reports, and vendor invoices in case they should have been recorded as liabilities. So we're focusing more on items that are not recorded or recorded very close to year end in the next accounting year. Existence, sorry. Getting aggravated. Existence. The auditor's major concern is whether the recorded liabilities are valid obligations of the entity. So the auditor should vouch a sample of items on the listing of accounts payable to other supporting documents. Do they exist? In cutoff, the auditor is attempting to determine if all the purchase transactions are recorded in the proper period. On most audits, the purchase cutoff is coordinated with the entity's physical inventory count. So proper cutoff should also be determined for purchase return transactions. So we just want to make sure, did they cut off for the recording of these items properly? Let me give you some examples in your reading. Rights and obligations. There is little risk related to this assertion because entities seldom have an incentive to record liabilities that they are not obligated to pay, right? But we want to make sure, is there a right and obligation there? And valuation. Accounts payable are recorded at either the gross amount of the invoice or net of cash discounts amount. So the valuation of accruals depends on the type and nature of the accrued expense. Okay, as we know, most accruals are relatively easy to value. So there's usually not a question. There's no complex calculations. You just want to make sure that there's consistency with how accounts payables are being recorded if discounts are being offered. Major classifications issues related to accounts payable or into other accounts involved in this, identifying and reclassifying any material debits contained in accounts payable, segregating short-term and long-term payables, so you want to make sure that they are reported correctly, and the different types of payables are properly classified. Disclosure items for the purchasing process. We want to look at the payables by type. Are they segregated between trade, normal business, officers payables, employees payables, short and long term? Are any long-term purchase contracts, including unusual purchase commitments, are they disclosed properly, especially if they are with related parties? Is there a dependence, a concentration, where they are depending on a single vendor or a small number of vendors? Okay, so that we want to disclose as well, or make sure it's disclosed somewhere in the notes to know about that risk. Another item used during the substantive test are accounts payable confirmations, just like accounts receivables have confirmations. Oh, shoot, sorry. Excuse me one second. Accounts payable confirmations are used less often than accounts receivables because they're usually a negative confirmation. I'm sorry, a positive confirmation, positive, and referred to as blank confirmations. The vendor is just asked to supply the balance owed by the entity. Once we are finished with our substantive tests, we have did our test of controls, assessed our detection risk, and created our substantive test. Now we can evaluate the audit findings. So all identified misstatements should be aggregated. The projected misstatement, remember, is then compared to our tolerable. If the projected misstatement from this process is less than the tolerable, the auditor has evidence that the account is fairly presented. Conversely, if it exceeds it, the auditor should conclude that the account is not fairly presented. Finally, auditing the tax provision and related balance sheet accounts. GAAP accounting versus tax accounting. Sometimes this is in our advanced module. We may need to determine temporary differences and permanent differences in our financial accounting amount versus our tax accounting amount. And employ the use of specialists in areas, especially if there's multiple locations or foreign operations, if there's business combinations or changes in ownership. Okay, so you could read through that, and if you have any questions, post them to the discussion board. But that is supplemental and just a little bit more advanced on our purchases and our cash disbursements auditing process. So that wraps up Chapter 12, all of the activities, Chapter 11, about all of the activities included in auditing during the purchasing process. Thanks, and if you have any questions, please post them to the discussion board.